Welcome to the Fear and Greed Business Interview. I'm Jennifer Duke. Every Monday here on Fear and Greed, we like to look at investing. And one of our regular guests is Chris Breike, the founder and CEO of online investment advisor StockSpot. He often talks about exchange-traded funds, or ETFs, what's popular and why they're appealing to investors. And today I wanted to focus on one particular type, cash ETFs. Firstly, though, remember, this is general information only. You should definitely seek professional advice before making any investment decisions. Chris, welcome back to Fear and Greed.
Thanks for having me back on, Jennifer.
So let's start with the very basics. What exactly is a cash ETF?
So I think a lot of the listeners you have probably have heard of ETFs generally before, which are these listed funds that enable you to diversify and invest in a whole bunch of different companies or securities at once. Cash ETFs are a little bit more unusual. I don't think too many people have heard of them before, but they're a way of essentially earning an interest rate from the big banks, but rather than depositing your money with the banks, you're actually buying something off the stock exchange that gives you access to deposits. And these ETFs go and shop around for the best deposit rates, and they have a lot of buying power because they're investing billions of dollars, and then they pass on those better rates to everyone. So they're more of an alternative to savings accounts or high interest savings accounts compared to other ETFs that allow you to invest into, for instance, shares.
So you're finding that more people are looking at cash ETFs at the moment?
Definitely over the last year or two, there's been a huge explosion in interest, Jennifer. And the reason is that the interest rates have obviously gone up a lot. And so people are more interested in savings interest generally. You know, there's also a little bit of reluctance to invest in shares at the moment because the economy is volatile. People are a bit worried about inflation and economic growth and unemployment and what could be happening in the future. So I think those two combined have led to quite a lot of interest in these products. The other big factor that's really driven interest is that the difference in the interest rate offered on these ETFs compared to what most people are getting in their bank savings accounts has really become a lot larger. So these ETFs now are paying a bit over the RBA cash rate. And listeners would know that the RBA cash rate at the moment is 4.1%. These ETFs are paying around 4.2% per year, whereas most bank accounts are only paying around 2% a year, unless, of course, you've found one of these high interest accounts. But often they have a lot of other, strings attached. You might need to use a card a certain amount of times per month, or you might need to not make withdrawals or other rules like that.
So can you take me through the different options available with cash ETFs?
Sure. So at the moment on the ASX, there are 3 different products listed. Now, in other markets like the US, there are, dozens of them. So, I would expect over the next couple of years, there'll be more options available. Right now, there are 3. Their ASX codes are AAA, which is the BetaShares High Interest Cash ETF. That's the one that we recommend to our clients for cash that they have, that they don't want to invest because they need it probably in the next 3 years, but they also want to earn a high return, and that's paying just around 4.19% at the moment. And then the other 2 are iShares products. There's the iShares Core Cash ETF, BILL is the code. And the third one is the iShares Enhanced Cash ETF, ISEC. And they're all pretty similar. The big difference between them is that they're depositing in different banks. And what I would say is generally they're all in, very low credit risk and highly regarded banks. And so, from my perspective, in terms of the recommendation we're making to our clients, I would say the money is pretty safe. The only caveat I would say is, unlike when you deposit your money in a bank in a savings account, you don't actually benefit from the government guarantee. So that's the main difference.
So there'll be investors of all different types of experience listening to this. How would they access a cash ETF?
Well, the most common way would be through a online stockbroker. And so if any of the listeners already have an online broking account, you can easily access them through those accounts. The only extra cost you have to be aware of, as well as the management fees that are built into these ETFs, is actually brokerage costs. And so you should be calculating, what's the impact of brokerage costs on your transaction. And that's why for investments of less than 3 months, I'd still recommend to listeners that, leaving the money in the bank is for most people the best option. But once you're looking to park that savings for 3 months to 3 years, and that might be to save up to a goal of, going on a holiday or saving up for your kids' education or putting money aside for like something like that, that's when these products tend to make good sense.
And how does it compare to, say, a term deposit or something like that?
Well, term deposits are really priced off the interest rate curve, which means, where are interest rates priced in the futures market, in the swap market, 1 month, 3 months, or 6 months, or 12 months into the future. Now, at the moment in Australia, the interest rate curve is pretty flat, which means that the interest rate we have today, which is 4.1%, is very similar to the interest rates, 3 months, 6 months, 12 months into the future. And so what we're seeing on term deposits at the moment is that the best rates out there that I've seen are around 5% at the moment. And that's for people if they're prepared to lock up their money for, 12 to 24 months. So certainly if you're prepared to lock up your money for a bit longer, the rates available are a little bit higher than these ETFs. The big downside to locking the money in, obviously, is that you don't have access to it in the short term. So if an opportunity comes up, for instance, if there's a share market crash and you really wanted to invest, there are some penalties to pull your money out of the term deposit. Whereas with cash ETFs, there's no penalties. So you're earning a little bit less, but you have more flexibility.
Stay with me, Chris. We'll be back in a minute. I'm speaking to Chris Breike, CEO of StockSpot. How do you say that cash ETFs would fit into a broader portfolio, and how should investors be thinking about them in that context?
Well, the way that we explain it to our clients is that if you're planning to invest for more than 3 years, or for any money that you don't need for the next 3 years, we don't really see a place for having too much cash in your portfolio, because over the medium and long run, cash historically has done pretty poorly as an investment asset class and has lagged even inflation. And so it's not a great place, because you're going to lose purchasing power and lose value of money over time for longer periods. So for longer periods of time, the portfolios we're recommending to clients don't have much, if any, cash. They're mainly in other asset classes like bonds and shares and property and infrastructure. However, for shorter term goals of up to 3 years, that's where cash has a great place in a portfolio. And that's because investing in the share market over shorter periods, and I think some listeners might think a short period is a week or two, the way that we would frame it to clients is actually anything up to 3 years is a short period in the share market. For that sort of period, your probability of actually earning a good return isn't good enough to justify investing, in my view, into the share market. And that's where a cash ETF, would have a good place, I think, in a portfolio.
And given that sort of big boom in the popularity that you mentioned in cash ETFs, where do you think the market's going to be for these funds in the next sort of 5 to 10 years?
Well, it's interesting. Historically, there was a huge explosion in these sorts of products. If you look back in history in the 1970s, when there was a similar, fast increase in interest rates and bout of inflation, and money market funds, they were at that point in time not ETFs, because ETFs didn't exist, absolutely skyrocketed in popularity, and they stayed pretty popular for a whole decade because they were offering, relatively good interest rates compared to what the banks were offering. And I think we're seeing a similar trend at the moment, that this is really the start of probably a trend that will continue for the next decade, which is that, banks are relying on people being lazy and not shopping around for better interest rates, sadly, like a lot of other, service providers in Australia. But for anyone that's savvy and prepared to shop around, these products are actually giving a much better yield or interest rate compared to what you can get in the bank. And while that difference exists, and at the moment it's about 2%, the average ETF, cash ETF return versus the average savings account return is 2%. While you can earn that extra 2%, I think the popularity of these products will continue to increase. Worth noting, in the US, that difference is even larger. It's around 3%. And there's been an even bigger level of growth in these products in the US, just because so many more people are realizing it's a better way to earn an interest rate.
Do you think it might actually give the banks a bit of a kick to up their game and pass through some better interest rates to consumers?
You'd hope so, but unfortunately, the Australian banking regime isn't particularly competitive when it comes to deposits, because there's a lot of people that are sadly just prepared to leave their deposits in bank accounts and don't put a lot of thought into the interest they're receiving, especially for short-term goals and needs that they have. So in a perfectly competitive market environment, absolutely, you'd think that banks would be competing for those deposits, but we don't exist in that world. And unfortunately, there isn't enough competition to really drive banks to increased interest rates anywhere near that sort of 4 and a bit percent that we're seeing in these cash ETFs. So my guess would be probably not.
So moving away from cash ETFs quickly, what other trends are you seeing in the ETF market right now? Is there still a fascination with AI and technology like semiconductors?
Look, at any point in time, Jennifer, there's always little trends that emerge in the investing landscape, and they tend to transpire now in the ETF world as well, because not only can people buy direct shares to, access a different thematic in the markets, but an ETF allows them to do that as well. So, over the last year, for instance, yes, all the ETFs that are focused on AI have really seen a lot of money come into them because the stocks that are within those ETFs have performed very well. The NVIDIAs of the world have really seen huge increases in their share prices. The other theme that's done quite well in the ETF landscape that mirrors what's happened in underlying shares is around lithium and the technologies around batteries. So those sorts of ETFs have also performed quite well. But these are very niche themes. And I'd say to listeners, if you're investing into these, just be careful not to invest too much of your portfolio, because just as they can go up 80 or 100% in a year, they can also fall by 50% in a year. And that's what we saw with some of these cryptocurrency ETFs over the last year, that they actually fell by 80%. So you can't have too much of your portfolio in these products. Otherwise, you're going to weather some pretty enormous ups and downs.
Chris, that was fabulous. Thank you very much for talking to Fear and Greed.
My pleasure.
And that was Chris Breike, the founder and CEO of online investment advisor StockSpot. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Jennifer Duke, economics correspondent at Capital Brief, and filling in for Sean Elmer. Have a great day.